afternoon and welcome to the last session of the day, where we're going to be looking at the key ingredients needed for raising a successful first-time fund. I'm Faye Margot, CEO of Brackendale Consulting, which provides investor marketing and PR support to private equity funds globally. Most GPs would agree that fundraising can be challenging enough at the best of times, but if you factor in a global pandemic, along with high volumes of LPs wanting to re-up, it certainly puts things into perspective for first-time funds. It's been estimated that as much as 83% of LPs this year are doing re-ups, leaving only 17% left for new investments, and of those, only a small fraction may well go to first-time funds. That said, there are obviously distinct advantages to investing in a first-time fund. According to research published this year in Preqin, first-time funds deliver outsized returns. That's to say more than 25% IRR, much more frequently than non-first-time funds, and they deliver poor returns, less than 5% IRR, much less frequently. And of course, they return capital more quickly, and they're generally more driven and more motivated, more hungry to deliver returns for their investors. In this panel, we're going to be looking at how first-time funds can deliver a successful investment model, how to stand out from the crowd in a good way when fundraising, and also, most importantly, what not to do. We'll be looking at some of the fatal errors made when fundraising and how to avoid them. So with me to discuss, we have two LPs, Johannes Wendt on my left, Director at Allianz Capital Partners, Olivier Keller, Senior Vice President at PineBridge. We have one advisor, Christophe Laura, Head of Investor Solutions at Asset Metrics, which provides back office support for both LPs and GPs. And crucially, we have two successful first-time fund managers with us. We have Tanguy Tozina, who's co-founding partner of Trajan Capital, which specializes in French MBIs and raised 110 million earlier this year. And we also have Médéric Gaillard, who's co-founding partner of Albarest Partners, a Lyon-based spin-off from MBO Partenaires, which is raising 100 million euro fund with a final close due earlier this year. So we have obviously lots of different perspectives on the topic. Before we start, it would be interesting to see if there are any first-time funds with us here in the audience. If you'd like to raise a hand. Oh, good. We have at least 1, 2, 3, 4, 5. Amazing. Good. And then do we have any investors with us who are considering investing in a first-time fund in the audience? Yes, we do. Good. We've got at least one hand there. And obviously, we've got some on the panel with us too. Okay, it would be good to keep this session as interactive as possible. There'll be time for questions at the end, but feel free to chip in from the panel and also the audience during the session. I thought we could kickstart this session by looking at, or at least identifying, what the main challenges to raising a first-time fund are. I mentioned in my introduction about the number of LPs choosing to re-up, but there are plenty of other challenges, at least especially this year, or last year rather, with COVID and not being able to have in-person meetups. So it'd be interesting to hear maybe from Médéric as a first-time fund, what challenges have you experienced?
Thank you, for sure. So we started fundraising in the beginning of 2020, which was a great idea, as you can imagine, right before COVID. We started fundraising in the beginning of 2020, which was not the best idea we had regarding the COVID crisis in the end of March. Nevertheless, we managed to get a few contacts, mainly thanks to our former LPs, which were investors in the PE firm in which we all come from. So this was our main asset, I guess, because we had mostly meetings with the people we knew, and no commitments during this specific period from people we didn't know. We had to wait for in-person meetings to get first commitments. So we hardly did our first closing in the beginning of February 2021 with well-known LPs, mainly with well-known LPs. Sorry.
And Tanguy, you didn't have the same benefit of having existing LPs to be able to meet with, did you? How did you manage? What sort of challenges have you experienced when fundraising?
Actually, we started a bit before Albarest here, because Trajan is a story that started at the beginning of 2018. We thought that we had a wonderful strategy that all the LPs would like to invest into. Sadly, it was not that easy, so it took us 18 months to do a proof of concept through a deal that we created and that we structured as a deal by deal to prove that we could do deals in our strategy. And then we find a sponsor, but I think we will talk about that later. And we actually started raising our fund at the beginning of 2020, and we reached final closing by June 2021, so pretty recently. Like Médéric said, COVID wasn't something that helped us, obviously, but through our ability to build a trust with LPs, we managed to reach our target in only a few months more than we thought it would take.
How did you manage to gain that trust? Did you manage to convince people to invest in you without actually having face-to-face meetings?
No, actually, it was impossible to get people to invest without face-to-face meetings. So we had a pause clearly in our raising in the middle of 2020, and it started over at the beginning of 2021. It took us an additional 6 months to raise the fund. How we built trust? So first, we structured that first deal as a proof of concept to show that we were actually able to deliver the strategy that we were selling, because before that it was only a PowerPoint and it's a pretty tough sell. Then we saw that it was pretty difficult to convince an LP to be the first one to put the money in the fund. So we thought, how do we convince someone to be the first one to put money in the fund? And what we found is that we had to give them some financial incentive to come in the fund. And this is what we call a sponsor. So what we actually did is that we gave them a bit of our carried. We gave them access to a share of the management company, and they put the first 10 millions in the fund. And also they brought with them, and this is very, very important, they brought with them a lot of clients, of their clients who also put in the fund. And then we reached our first close this way. And then to go on building trust, what we did is that we offered co-investment in the first deals of the fund to create more relations, to show as many people as we could that we could deliver what we were saying that we will deliver in the fund. And this is how we almost reached our target of 110 million.
Some good tips there amidst all the challenges that are obviously going along with the competition at the moment. Maybe we can now look at why an LP would want to invest in a first-time fund. Why, maybe Johannes, you can say what's attractive about first-time funds?
Yeah, I mean, apart from the attractions, there are some real obstacles, obviously, because the opening hypothesis is why would we? And why would we? Not out of arrogance, but simply because if we look at the returns on our portfolio, they're really driven by not by a small spike, which is promising and good or very good, but by avoiding the 200 million blunder somewhere. So we are probably within the spectrum of LPs. We're probably still among the conservative and risk averse. There is, however, clearly a benefit in first-time funds, because if it's a journey, we typically look for funds to work with them for whatever 2, 3, 4 fund generations. If you're not on that first train to depart the station, I think we can always come back for the second fund if it works well. Well, if it works well, chances are we can't come back, because either you really increase the fund size, which then we think, well, it's still the same thing that they're going to do, or they don't, and then there's no seat for us at the table. So there are real attractions of joining a first-time fund, but it is a little bit of a daring bet for us. So we do it selectively. We do it when we know the people well, and we try to pick our battles carefully.
And you used not to invest, didn't you, in first-time funds? You were saying.
Well, we do. I know it's a very common notion in the market that we don't, because probably there are by far more no's than yeses. But I did do a little bit of homework on this, looking through our portfolio, kind of limiting it to the European portfolio. And kind of over 25 years, there's ballpark somewhere a notch above 10% of them are first-time funds. In all fairness, I had real difficulties of counting what is a first-time fund, because you have the real first-time funds, which is a new GP, a new platform, a new everything. You have those where you have a new team on an existing platform. You have those which is a spin out of one or the other. So I have all kinds of shades of grey in there, but still we've done quite a few first-time funds. Frankly, we're very happy with the first-time funds we have. But it is a small number, and over the last couple of years, it's been the odd first-time fund that we've done every year, kind of.
We were discussing on our pre-panel conversation, actually, how you define a first-time fund, because obviously there have been quite a lot of platform extensions recently. Alistair Watson, who was due to be on a panel but sadly is unable to join us from Aberdeen, he was saying that there's been about 10 new names now in the platform extension category this year, and that's obviously, I don't know, would you classify that as a first-time fund, Olivier?
I think I would. I mean, certainly from an institutionalization perspective, there's a lot of concerns that fall by the wayside from the beginning in terms of having a reliable platform, strong institutionalized processes and all that. But nevertheless, typically these teams are new teams that are being put together around one or two existing partners from the flagship platform of that particular manager. But these are new teams structured around that, and there's no guarantee that there will be any success resulting from that. So they are a bit of a special animal in a way, also because they will be benefiting from deal flow generated by the parent company, which is not something a standalone first-time manager would enjoy, but overall it would still slot them into that category, I would believe.
It's arguably potentially easier for them, obviously, to raise funds. They have less.
That's for sure. The whole fundraising infrastructure behind them is very strong, typically, compared to what a really new first-time team could do.
And what's your take on first-time funds, Olivier? What do you find attractive about first-time funds?
I think a lot of what you mentioned in the beginning is absolutely true. So it is the fact that first-time teams are often betting the farm on the first fund succeeding, because they will never have a functioning firm if that first fund doesn't deliver the results that LPs are expecting. And at the same time, starting a new firm requires a substantial upfront financial commitment from the partners as well. They need to pay salaries up front out of their own pockets. They need to pay for all the organizational costs up front and so on. So they're really taking an entrepreneurial risk that is a strong incentive for them to perform as strongly as possible. At the same time, certainly the distraction of legacy portfolios falls away, and you know that the team will be solely focused on managing the pool of capital that you've invested with. So there are a lot of interesting aspects to first-time managers, and we continue to look favorably at that.
Tanguy and Médéric, what advice would you give to someone today who's starting out at a first-time fund? What would you say are the key ingredients for success?
I would say that despite everything that has been said, first-time fund is not a strategy. I've never seen an LP looking at the numbers that you just mentioned and saying, oh, those good numbers are great, I'm going to invest only in first-time fund. In our experience, being a first-time fund, it was only an inconvenience that you had to overcome in order to be able to reach your target of raising a fund. So what I would say that in that market, in this market, nobody is expecting you when you're building a first-time fund. You're a nuisance to a lot of people. You are a new competitor for the existing fund. You're a new line to follow for the LPs, the huge LPs that have many other relationships that they want to culture. So how are you going to overcome all these hurdles? And really what I see as the main positive thing in a first-time fund is that in order to overcome all those hurdles, you will have to come with something new. You'll have to innovate. You'll have to offer something more than what the other funds are offering. So my first advice is do not come up with the the plain vanilla LBO fund, small mid-cap. I think nobody needs that in the market, so come with something new. And then build trust by building relationships through transactions that you can offer to your potential investors. And also it takes time. It took us a bit more than 3 years. We started without any LP relationship, so we had to build that. And I think everybody around us told us that we were pretty quick in building that. So it takes time, bring something new, and take the time to build trust.
Some good advice there. Médéric, what would you add to that?
Well, I perfectly agree with what Tanguy said. Maybe 2 more advices. The first one would be try to define and to target as quickly as possible the category of LP which would be able to invest in your fund, because it's quite easy to get appointments, to get meetings with some LPs, but most of them are just here to know about you, to know your story, to map the market, and maybe to have you to have your fund in the screening for Fund 2 or Fund 3. So try to save some time and to target very specifically the kind of LPs that will have the ability to invest. For example, family office, entrepreneurs, local institutionals. That could be some advices. That's the first thing, and also regarding the size, because for a first-time fund, if you are targeting 100 million or 120 like us, it's a quite small fund actually for big institutional players who invest at least 30-40 million euros in the funds. The big ones, the insurance company, for example. So try to focus on this. And the second advice would be on deals, either a proof of concept, or maybe just try to generate as much as deal flow as possible. Try to go as far as possible in the deal-making process, because this was what made the first closing of Albarest happen, actually, because we arrived at some point where we needed the money to invest it. And it's only when it was an absolute necessity that the LPs that we had in the pipe said, okay, we go for it and we invest, and everything was all very sudden because the deals made the first closing of the fund happen.
Many would advocate starting with a deal-by-deal, on a deal-by-deal basis before raising a first-time fund, wouldn't they? Instead of to just demonstrate some track record if you're a new fund.
It can. I mean, I'm maybe not the best person to speak about the deal-by-deal strategy because we didn't do this, but it could. The other point is that while you're doing this, you're putting maybe a good asset in a fund that you're, or in a specific vehicle that you are not managing yourself, so it could be tricky.
Just a question to the 2 LPs. What would you say are prerequisite elements that you would look out for if you're investing in a first-time fund?
Go ahead.
Okay. Prerequisite elements. I think there's a long list, but to maybe pick out just a few. On the strategy, I think it's very much as Tanguy pointed out before already. And there has to be a degree of separation and a degree of differentiation. It's very hard to market yourself on doing the very same that a lot of established groups are already doing. So there has to be a strategic differentiator, and it has to be credible in that the team has to have done that before. So it can be a lot of different things, I guess. It can be sector expertise, focus on overlooked geographical niches, could be a focus on complexity, on certain types of deals such as carve-outs. So there's a wide range of things, but there has to be a certain differentiator or a set of differentiators that will allow LPs to really understand what sets this group apart. And then, of course, from a team perspective, I guess team is among the biggest detractors for many LPs because there's no guarantee that the chemistry will work out. There's no guarantee that the team will be able to form a true partnership and make collegiate decisions and be well balanced. And in that regard, it always helps to have a team that has worked together before in some capacity, or at least have certain partners who have worked together before, be that at the same firm or be that across different firms, but having worked together on certain deals and so on. So the more tangible evidence there is of these people being able to get along, to work together on a shared vision, a shared strategy, I guess the easier it gets to underwrite the fund.
Anything to add to that, Johannes?
Not an awful lot. I think it is about building trust. Any first-time fund has that in common with someone raising fund number 8, 9, or 10. You still have to build trust or continue with that trust. I think it can often enough be an iterative process. So, a first-time fund or manager shows up and you kind of register it and you don't care about it. And after a while they come back and they've actually done what they said they would do. And they come back again and again. You think, okay, at least, there's some perseverance here. But there are many different ways of building trust, but ultimately, if we do decide to commit, we're handing them over a blank check, or hopefully at that point there is a little bit of visibility what that check is for. But ultimately, we need to have the trust, and I think we're maybe not. I wouldn't go too far on the strategy has to be awfully differentiated. I think if we simply see that there is a team that's very good at what they're doing, or has been very good at what they're doing, I think there can be different funds or teams in the market doing kind of the same things, but one will be better than the other.
Christoph, we've not heard from you yet. Can you maybe talk to us a bit about how you can help first-time funds and what it is you do in your service offering?
Yeah, very good. We support first-time funds typically when they had the first closing, and then we could start with partnering work like all the words I've heard, cost, trust, is being an efficient partner, not building up a lot of headcount and back and middle office duties you have to make with highly experienced people, which are costly, because we can support here with all the regulatory stuff, but also building trust through a partner who brings a platform to the table which is very reliable, which is tested by others, and which delivers the needs investors have regarding, for example, reporting or digitalized communication between all parties. So this is where we see our core and where we can help first-time funds.
Sometimes first-time funds worry about coming to you as a service provider if costs are an issue. Do you find do you find you're still seeing first-time funds or do you see wariness on their part because they're trying to be conservative with their cash flows?
Yes, absolutely. First of all, for us, it's a bit more difficult to detect first-time funds, but they typically do not come to us as they come to you as asking for money. And we work a lot with law firms, structuring law firms, and they promote asset metrics there. The cost structure we bring is when we calculate it with small teams, first-time funds maybe between 4 and maximum 6, 7 headcounts, and if you put the half of the headcounts in back and middle office and not in doing investments, I think it's a bad payoff of your capabilities.
I think on our panel call, you as LPs spoke favourably of first-time funds that do seek outside help to relieve the accounting burden, didn't you?
Yeah, I think once we've made the commitment or kind of made the decision, it's not the end of the story, it's a beginning. And then you get all these questions from the operations team and holding something up and say, is this supposed to be a capital call or what is it? And if you have some level of professionalism there, that helps. Actually, it doesn't only help, it's a real requirement. It's also, we've met some of these young teams, whether it's first time fund or second fund, sometimes they at the next meeting they come with this big happy smile and say, we hired a great assistant or a great office manager, and you're like, okay, well, that really helps the investments, doesn't it? But you realize how much burden it takes off their shoulders, and they have their night back, whereas before they've done the accounting or they've kind of put up the capital call or whatever it is they did late in the night. So
it's a small team, you can't do everything yourselves, can you? Okay, this now leads on nicely to my next point, which is we've obviously looked at tips for success in first-time fundraising. I thought it'd be interesting to now look at what not to do when first-time fundraising. Interesting from maybe an LP's perspective to see what sort of approaches they've had that they've said, no, we're definitely not going to invest in your fund. What has gone a bit wrong, without naming names, obviously. But any interesting stories you might have?
think in general, one element that is always dangerous is when you feel the person across from you is suffering from any kind of hubris. I mean, there's overconfidence is a big risk, especially in the first-time situation, because this is a bigger challenge, I think, than many investors realize sometimes. It is not just about so you have partners coming from other groups, and they've mostly been deal partners. They've done transactions. Starting your own firm entails much more than that. It's about running a firm. It's about running a partnership, making HR decisions at junior level, and so on and so forth. So there's this added layer of complexity that comes in, and facing that obviously can be done successfully, but facing that I think requires a certain degree of humility and a clear awareness that this is a big challenge. And whenever teams are starting to downplay that or insinuating that their past track record is an automatic guarantee for success, it becomes pretty difficult for them to remain credible. Overall, I would say pitfalls to avoid. It's all about, as Johannes said, actually, it's all about building trust. And so it's all about consistency and credibility. And so whenever there's a lack of transparency, whenever there's information they're not willing to share, whenever there are references that do not check out, and so on and so forth, obviously these are big red flags. So I would say beyond avoiding overconfidence, again, transparency and consistency are crucial elements to maintain.
It must be about getting the right balance, because you want to show a bit of confidence in what you're doing, obviously, but then to maintain a sense of realism as to what your expectations are.
Oh, absolutely, sure. I mean, with regard to the investments, the strategy, and the vision, and you do want to see enthusiasm, that's for sure. But it's maybe a fine line there, but it's certainly a line that can be, that is discernible and that shouldn't be crossed.
Anything you'd warn against, Johannes?
It's tough. It's tough to raise a first-time fund, I'm sure. And when you come to those meetings, after whatever 45 or 60 minutes, you have to have left some impression, something that I remember from that meeting, and kind of think of remember next time you come around. And I think the challenge is it goes in tiny increments. It's a little bit like this old kiddies game of snakes and ladders. You go like little steps up and up and up. And when you get to a point where you have the impression that they're kind of trying to sell something as special, which is really bog standard in the market, you slide all the way back down. It's like you've got to be kidding. This cannot be your pitch. It's hard to really pinpoint when does that happen, but when you praise a process or when you praise an idea which is really reasonably broadly practiced in the market, then you at least take a little one of those slides back down.
I'm guessing that the average time as well when fundraising starts, first-time funds, it's a longer process when they are first-time funds, because you need to do more due diligence on them.
Yeah, I think it's probably doing more diligence. I think that's true. But if you're really counting the net working hours on, now we have this file in our hands and on our desk, and now we're doing a reference call. If you add all those minutes and hours, it's probably a little bit more time. But I think the real time factor is it's an iterative process of sinking in and listening to what you say, and kind of you forget about it. You come back after I don't know so many weeks or months, and you think, okay, we're still around. They're still saying what they've said last time, and actually they've done some of what they said. That's helpful. And that it doesn't go. You can't compress that time very easily.
I think lack of transparency as well. We mentioned before about the deal by deal methodology. I know some managers count them as actual funds, so when they start to raise their fund, their first fund will be called whatever Capital 6, giving a misleading impression, and I guess that's not ideal.
Well, yeah, I think deal by deal helps, simply because that is something we can, usually without a doubt attribute to the team that we have in front of us. So I think deal by deal helps. It's a huge step from talking about this is our strategy, this is what we do, this is the people involved, this is how we go about it, etc., to this is what we've actually done. And in some cases, actually, there's a little bit of a moment of truth, and we look at the deal and think okay, it's not exactly what I had in mind, but good to know that this is what you are doing. So I think deal by deal, even if it's just 1, 2, or 3, it helps incredibly. It puts you into this is someone who's done something as opposed to someone who has a plan to do something.
And we touched on co-investments earlier on as well. Is that something that would be a deal breaker for you as a LP investor in a first-time fund, either Olivier or yourself?
No, but we generally we make a fund commitment first, saying that we really believe in this manager. This is someone we back, and then kind of step number 2 is we're happy to double up on select investments and make a co-investment there. And it, to show us a co-investment, even if we don't do it, but it's helpful because we see what is it that you do, and how deep do you go into your diligence? What kind of risks are you willing to take? What can you diligence away? What can you structure away? And what at the end of the day is the business of equity underwriting?
Is that the same with you, Olivier?
Yeah, I would agree that working with a GP on a potential co-investment certainly gives LPs a lot of insight into their way of operating, into the depth of their analysis and so on. And so it can be very conducive to raising the fund. And at the same time, I think many investors investing into first-time funds would see the potential for co-investments as an attraction as well, and would probably expect the GPs to share co-investments along their investment periods. So it's certainly a powerful instrument for new managers.
Would that be a deal breaker for you if they didn't want to do that?
I don't think that should be a deal breaker ultimately, I think. But to be quite honest, I don't recall many instances where GPs ruled out co-investments entirely. I don't think that's market practice.
Not in a pitch meeting in any case, right?
That's for sure.
What's your position, Médéric, on co-investments? Are you intending to?
Well, we have some demands for staple investment with primary and co-investment at the same time, specifically from international fund of funds. What we did since the beginning is to give the priority to the first closers, because we were really happy to have them in the fund at the beginning. So they trusted us when we needed them. So the first deal we did were with the first closers, and we tried to do this. If we have the opportunity, of course, to give some co-investment to a new LP, which would be interesting for the fund, probably we will. But our rule is this: first give the co-investment to the current LPs.
Okay, Tanguy, what are your thoughts?
Well, we actually onboarded some LPs that were first co-investors in the first deals of the fund. So that actually helped a lot. But what we see in our experience is that the difference between the number of LPs that ask for co-investment and LPs who are actually able to do a co-investment and to invest in the short time frame that you have when you are setting up an investment, there is a huge difference. So what we did is that we did not commit firmly toward one specific LP that he will have access to co-investment. We said that yes, we did offer co-investment, but that the rule would be first arrived and more agile, then this one would be served. And this is how we managed it, but clearly it helped. And I think this is really a rule of thumb, but maybe more than 50% of the LPs ask for co-investment when they first meet you and want to know about your strategy.
I'm curious to know. Oh, go ahead, Chris.
Just to mention it for the investors, we could track the target funds and the co-investments.
Okay, good. It's good to know. Tanguy, I'm interested to know where geographically because obviously your deals are focused on France, where geographically most of your investors have come from.
We are a small fund. 110 million fund is a pretty small fund, and we have a strategy that is very much France-centric, even though we are looking at deals in close countries such as Belgium and Switzerland. But I'd say that 95% of our investors come from France. Some of them come from Belgium, and some of them from Switzerland. So our LP base is very much linked to where we do investments.
And have you found more interest from family offices rather than institutions in general?
Yes, clearly, yes. I think Médéric mentioned that you have to be focused on who you are talking to when you are raising a first-time fund, and this is clearly what we experience as well. We spent a lot of time talking to institutional investors, and a lot of those meetings went very well, but ended by, "Oh, that's very nice. Let's meet for fun too." And in our experience, it's really a huge hurdle for these huge LPs to invest in a first-time fund. I mean, why would they do that when they can invest in teams that they already know, that they've been working with for years, and you have
But they're
nothing
already
to
rich,
show?
right? They may already be rich as a first-time
Yes,
fund. You're more driven
yes,
and
but
got more-
it's a very tough sell to tell them, well, all those guys who've already made you rich, now they're too rich, so you should invest on the guys who are not rich yet. And yes, trust us, we'll do the next. This is a very tough sell. And compared to the comfort of a relationship that has been going on for years, we thought it was pretty much, I won't say totally impossible, because we have some institutional LPs, but it was very, very difficult to convince them investing in a first-time fund was a good bet for them.
Definitely unique aspects, like the fact that you're not distracted by an existing portfolio. You've got something to prove because you're new in the game, and your money's in it. I mean, you've offered a financial incentive, didn't you, for your first LP investor?
Yes, all that is true. All that is true. But if you put that in the balance with the relationship with an existing fund, it can't compare. That's why I told you that to convince the first big investor to come in the fund, we had to give them something more.
And also, I guess, the size of your fund as well, being a smaller, in the general scheme of it, fund for institutions, many like to not have a 10% stake and not 20% stake in your fund. So, and depending on the lowest ticket size, I know a lot of institutions only start at 50 million, right?
Yes, that is true as well. I mean, when you raise a 100 million fund, and institutional investors don't want to invest less than 50 million, and at the same time don't want to hold more than 10% of your fund, you can go into the meeting, but I mean, in the end, it won't happen. So
Yeah.
maybe for fund two, if you're lucky enough to raise a fund two.
Good. Do we have any questions from the audience at this point? Yes, go ahead.
How did you manage, I'm talking to Midweek and Tanguy especially, how did you manage to organize what I call the chicken in the oven before having the first closing round? I mean, how do you manage to source deal without having the money?
So the question is, how do you manage to source deals without actually having the money there to be able to acquire them?
Your name on the market.
It was tricky. No, obviously. Well, what we did was we continued to study investment opportunities, and as we had very good relationships with well-established family offices, what we said to for example, M&A boutiques or to the entrepreneurs was we do the deal, and it will be backed by someone else if we haven't raised the fund yet. That's what we did, and at the end, we managed to achieve the first closing and to invest ourselves. But the second plan was to warehouse the deal by a very close family offices with which we had already worked in the past.
What exactly do you mean? It will be backed by someone else who'll do the deal?
It was to warehouse the deal. I mean, for example, the family office would invest in the deal. We would manage the deal, the portfolio company. We will have an agreement with the family office for fees carried, etc. And we had all written down. And this was the B plan, and the A plan, of course, was to put the deal in the fund.
Good. What about you, Tanguy?
Yes, I'll say pretty much the same. There is a lot of money in the market looking for opportunities. So you have to be confident that if you build a good deal, you'll end up finding the money. Maybe you will not take as much fees, as much carried as you expect, but if your deal is good, you'll find the money. If you don't find the money, then maybe you should ask yourself some questions about the quality of the deal you've just structured.
Good advice. Any other questions in the audience? Yes, we have a lady here at the front.
One question to institutional LPs. Are you contemplating to create an incubator inside your companies to support new initiative and fund space, which is a part of your usual?
The question is if you're looking to start up an incubator in your company to
You have
help
incubator
first-time
for
funds.
Traditional startup in other sector, but not in private equity or VC.
I mean, contemplating, yes. There is something that we contemplate, which we call the Emerging Manager Program. Because, we manage a very large portfolio on a global scale. It's more than 100 live GP relationships. And frankly, some come to the end of the journey at some point, and they need to be replenished with highly motivated people. So we need to, not only grow the tree and watch the top, but kind of plant something at the bottom as well. But I think contemplating is probably the right stage where we're at. It's not specific yet. It's not a real program yet. But it is kind of struggling and trying to find a solution to all the problems we have from the institutional side, to set apart a pot of money and say, okay, let's see what comes out of that.
Anything you're able to comment on?
Yeah, certainly it's an interesting concept, and so I would support what Johannes just said.
I just wanted to add that during our raise, we actually met some LPs doing just what you said in Germany and in Switzerland. What we thought of it is that you were actually working for them, and it was not quite compatible with the entrepreneurial spirits that you have when you create your own fund. As I just said, there is a lot of money in the market. So do you really need an incubator? I mean, there is money in the market. It's not that expensive to structure a deal. Maybe the only aspect is the due diligence. Who's financing the due diligence? But if you find out a way to finance that with the money in the market, you should be able to build up your own incubator. Well, that's my opinion.
Christoph?
Have you also tried to or maybe you have gotten money from institutions like the European Investment Fund?
You're looking at me, so I guess you're asking me the question. Yes, but for us, they are an LP like the others. They have the same. What in our experience, they behave the same way the large LPs behave. So it'll be the same.
We see some first-time funds receiving money from, in Germany, Kreditanstalt für Wiederaufbau, KfW, or the European Investment Fund, and they write good tickets. I mean, that's visible.
Yeah, EIF is one of our main sponsors. They were a first closer of the fund, but we had the chance to know them from our previous experience. But they do first-time funds. They are very professional in the due diligence. The other good point is that they sometimes allow you to give their reference to other LPs, and other LPs know that they have a very deep due diligence process, so it can save time for you, save time for other LPs, and to get the due diligence from EIF. So that's a good point too.
Any other questions from the audience? Yes, we've got one here.
How did you manage to talk about your own individual track record of your previous experience? How did you manage to talk about that?
I don't know if everyone heard that, asking how they managed to talk about their previous track record in the fund. So, Médéric?
Well, for us it was quite easy because we're a spin-off from MBO Partenaires, and we're a Lyon-based office. We had a lot of autonomy in the deal, so all the deals that we have achieved were 100% held by the team. Maybe one or two of them were not 100% held by the Albares team, but what we did is that we disclosed very precisely who did what, to be very transparent and to give some trust to the LPs. So it was very clear for us, quite easy.
On our side, it was a very tricky deal because Thomas and I were investment directors in our previous team. So even though we were working on deals, we always had partners above us. So it was very tricky to discuss, this is my deal and I own this deal. So we had a negotiation with our former employers, and we had to negotiate what we could say and could not say. And in the end, we could not say much, but we did with what we could say, and that's it. And this is why we had to go through the process of building a proof of concept, which was the club deal I just talked about, to show that even without those partners above us, we were able to create our own track record and our own to lead our own deals. But this is a tricky part, and I don't know of any other way than go and negotiate with your former employers.
I can see there's more interest from the audience to ask questions, but I've been shown the timeout card. I actually had a quick question myself. I don't know if I've got time for that, have I? Probably not. I was going to ask each panelist to say one quick bit of advice about, okay, she's nodding her head, about first-time funds. If you had to give one piece of advice, what would you say? Maybe start with Johannes, because you're next to me.
I don't know. If you're convinced this is your dedication and vocation, go for it.
Thank you.
You'll find it somewhere.
Olivier?
I would agree. Persistence is certainly the name of the game, and continuing with push through with the vision, especially in times as challenging as these, will be crucial.
Tenacity. Okay, good. Frederic? Médéric, sorry.
Go for it. It's a great entrepreneurial adventure, but be sure to be partnered with the well team, because you might go through some tough time.
Good.
Provide transparent, reliable reporting to your investors.
Perfect. And we all know where to go as well. Great. And Tanguy?
Well, find the right partner, because it's going to be a tough ride, and be innovative. Bring something new.
Great. I know people in the audience had more questions, so maybe you can come and find our panelists once we've finished. I've been asked to read this out. Many thanks for listening. We are closing the conference of the 20th edition of the Private Equity Awards and Exchange and Awards even, and we look forward to seeing you at the cocktail party at 6:30. Thank you everyone for your attention.